purchase price allocation is a very long, complicated process to determine one thing: how much goodwill is going to be put on the balance sheet after an acquisition. It's a lot of fun to acquire businesses. Most clients don't think about what the compliance implications are from a financial reporting perspective when they're making that acquisition. And so when it comes time to complete the audit, it can be a surprise. I don't think that purchase price allocations have to be the fire drill that they sometimes become. Preparation can make a massive difference. The main goal here is to provide some tips that you can share with your clients, or if you're undergoing a purchase price allocation, if this is coming, to give you the opportunity to prepare for it on your own, so that when you need to pull the trigger on the process, that you're well prepared. The nature of goodwill is such that it's very difficult to value directly. You have to determine the value of goodwill by eliminating everything else. A purchase price allocation effectively happens in three phases. The first phase is you retain a specialist, and the SAS 73 covers the process for using the work of a specialist. And in an audit and accounting context, I would be considered a specialist. The specialist performs that purchase price allocation, and then it's the auditor's job to test the purchase price allocation, and they either accept the PPA or they ask questions. And this is where the rubber starts to hit the road. The more preparation you put into the purchase price allocation, the fewer questions you are likely to receive from your auditor. And the questions you do receive are probably going to be softball questions that you can bang out in 30 to 60 minutes and you're done. Sometimes there are no questions. If you do this right, there should be not a lot of questions, and most of them will be of a clarifying nature rather than of a challenging nature. The purchase price allocation itself, as I mentioned, is intended to determine the fair value of goodwill that's going to be placed on the balance sheet, and then is going to be subject either to amortization or potential impairment later on. The way that it works is you start by determining the price that was actually paid. And at first blush, that may seem strange. Wouldn't every company know the price that they paid? If they paid in cash and cash only, the answer is yes, they probably do. But most transactions don't take place using 100% cash consideration. And therefore, the price is very much up in the air and is actually the most complicated part of the PPA process. You then subtract the fair values of tangible and identifiable intangible assets. And that's how the purchase price allocation works. You subtract the fair values of identifiable and tangible assets, patents, copyrights, trademarks, and so forth. And then whatever's left over is the goodwill. Find a fair value of goodwill to put on your balance sheet, basically by the process of elimination. I want to stick up for the auditor. The auditor is placed in the position of being a gatekeeper. I hear often that auditors are making somebody jump through hoops. I've never met an auditor once that had so much time on their hands that they wanted to make somebody jump through hoops just for the sake of jumping through hoops. They do have obligations that, when a purchase price allocation is submitted for the audit work file, the auditor is required to exercise due care and show evidence that they exercised due care. This becomes an audit work paper and needs to be treated as such. Even though it's a valuation work product, it is ultimately an accounting input, an audit input, and therefore needs to be treated with that kind of respect. And auditors have a fiduciary responsibility to their client and to the people that are going to rely on the information. I don't think I've met an accounting firm that treated it with anything less than the full respect that it was due. And ultimately, they have to determine whether or not the purchase price allocation document is sufficiently reliable to meet audit standards. The accounting world has an obligation to maintain the public trust, and that includes the valuation component. Some valuation people, particularly ones who are not experienced, get upset by this. That comes with inexperience and maybe even a little bit of insecurity. But we all should be trying to accomplish the right thing, which is to make sure that the client has a clean audit with as little conflict, drama, delay, additional fees as is possible. It's important to note that the PCAOB, which is the organization that is effectively the watchdog for public accountants, to this day, roughly 50% of the weaknesses that they cite and have identified still arise from fair value measurements within the audit. And many of those, if not most, involve the purchase price allocation. This is something that is complicated, but it's also an area of scrutiny. So you need to understand that as a serious exercise. And I think this is fairly obvious. Financial restatement for any reason is bad. It's not something anybody wants to do. The accounting firm never looks good, even if it's not their fault. And then if it leads to a material transaction that ultimately relied on faulty information, that's mega bad. That's malpractice time, right? Financial restatement means damaged client relationship, damaged reputation, potential loss of fees because the client's not going to be thrilled about paying to fix a mistake that was made in the audit that wasn't their fault. But then you get into material misstatements that lead to distorted decision making, and that's where malpractice comes into play. Nobody wants that. So because the PPA is so complex, it's so often cited as a reason for a material deficiency in an audit, you better believe that from the auditor's perspective, it's going to be a point of emphasis. What exactly is the auditor trying to accomplish? They're auditing the work papers that was sent as a purchase price allocation document. And this will differ by auditor. Everybody has a little bit of a different flavor to this. But most of them are going to test the key assumptions. And by testing, not only are they going to want to know where that assumption came from, they're going to want to understand the basis for that assumption. And in some cases, they will test whether or not that assumption, if wrong, has a material impact on the final determination of goodwill value. Some auditors will go through and check the math. So it's a good idea to help check the math. And by the way, there's no better way to understand a valuation document than to go through and check the math. They want to know if generally accepted valuation procedures are used. It is not as much of a rules-driven profession and institution as is the accounting world. That doesn't mean you can just sort of go out there and throw up any methodology that you want. It has to be accepted into the audit papers. One of the checkpoints that auditors have when checking any fair value documentation is, what were generally accepted valuation procedures used? And if not, you are going to be asked a lot of questions about where did this come from and why should we believe it? And has anybody else used this or accepted this? The auditor's job is to assess general reasonability. Would a prudent expert coming behind and performing a similar assignment reach a similar conclusion? They do have to make an assessment. This is part of SAS 73 as to whether the specialist is sufficiently competent and independent. And more generally, it's going to be about, have you done assignments like this before? And are you using generally accepted valuation procedures? In every memo that I ever put together, I would attach a summary biography of the purchase price allocation preparer. Valuation, by definition, recognizes and relies heavily upon informed professional judgment. So you must be able to trust the judgment of the appraiser before you can rely on the work product. The hardest part of this process may be determining the price. If I look back on all the PPAs I've done, I think the most complicated ones have been how to figure out the price that was actually paid. And generally, the two complications here that occur most frequently are contingent consideration or earnouts. You don't know how much that earnout is going to wind up being in the end. And so you need to have some sort of rigorous process to estimate what that should be. And 10, 15 years ago, auditors might be okay with the client saying, well, we think there's a X amount of probability that Y amount of dollars are going to be paid. That generally doesn't fly anymore, certainly not for the big four and for the public accounting firms. They're going to need something more rigorous than that. As you're advising your client about addressing contingent consideration, advise them that there are going to be separate, rigorous processes required in order to execute that. The second is stock consideration. So many transactions involve now the payment in the form of stock. If the acquirer is public, then that doesn't pose any problem. You look up their share price as the date of acquisition, multiply by the number of shares, as long as the company is relatively liquid, and you have your purchase price. But what if there's shares in an illiquid company? What if there's shares in a new co? There's a complex capital structure. So you may wind up needing two valuations, one for the purchase price allocation and another one to determine the fair value of the company and the shares that were paid in consideration. That can expand the scope of the project significantly. Deferred revenue can be a complicating factor. That typically occurs with software as a service companies, AI companies. After FAS 123R went away and was replaced by ASC 805 to govern acquisitions, one of the changes was they removed the provision that acquisition costs would be rolled into or added to the total purchase price. They now aren't. However, I'm seeing more purchase agreements that specifically state that the acquisition cost is going to be borne by the buyer. And therefore, in spite of the fact that under general accounting rules, it's not included, it winds up being decided that the transaction costs wind up being added because it was contractually written into the agreement. This is what a sample purchase price buildup might look like, depending on how complex it is. And it's going to involve cash paid. If there was an earnout, then that's going to have a separate line item. Stock acquired in the transaction or stock paid is going to be a separate line item. Liabilities assumed, and then a working capital adjustment. Each transaction is going to be different. But I just wanted to include this in order to provide an example as to what this may look like. So the general point here is that increasingly, as deal terms are used to bridge the gap between buyer and seller pricing, the price itself becomes one of the more complicated facets of the purchase price allocation. The way to address those price complications is to be transparent about them. This is one of the reasons why it's important for the auditor and the specialist to have a lot of communication at the start of the assignment and along the way to make sure that we're not doing processes that aren't separately needed. And then, is the separate valuation going to be needed for stock consideration? And if so, the time to let the client know that is very early in the process, not when the audit team is on site and we're hoping to issue the audit within 3 weeks. That's not the time to figure that out. Many companies still have tangible assets. Manufacturing companies, retail, food service, and so forth. And the key thing I just want to point out here is that most people who do what I do in business valuation do not have expertise in tangible asset valuation. That is typical. These are separate disciplines that have separate certifications, separate areas of expertise. And so it's important to have this process go smoothly, that we determine if a tangible asset appraiser is going to be needed. If the tangible assets are going to be a material portion or factor in the purchase price allocation, then it may be necessary to bring in one or more separate specialists in order to nail those numbers down. The key is just to not surprise anybody. Now, what I do, what people like me do as a part of this process, is determine the valuation of the intangible assets. It's so critical to create lines of communication between the auditor and the specialist. The way to do it correctly is to have the auditor and the specialist get together. The auditor will direct the specialist. At the end of the day, the auditor is the one reviewing this. So they should be the one driving this bus. The auditor will which assets they think ought to be included. It's a great way to avoid a lot of confusion and make sure that we're not doing more work and therefore charging more fees than we absolutely need to. Not all intangible assets can easily be transferred. For example, if a customer list or customer relationships are all in the owner's head and the owner is not planning to join the company after the acquisition, then the customer information may not be physically feasible to transfer. Some assets may not be legally permissible for national security reasons, for example. You may not be able to transfer assets to a Russian buyer because if you did, it would violate US sanctions. Under US GAAP, there is something called the private company option, which potentially eliminates the need to consider customer-related intangibles and non-competition agreements, which is good because those are some of the more time-consuming intangible assets to analyze. But don't assume that the auditor is going to grant that option. The specialist shouldn't assume that. You as the CFO or the advisor shouldn't assume that. The auditor is going to make the determination as to whether or not that is appropriate. Here's a non-exhaustive list of intangible assets. And the key takeaway here is that for whatever intangible assets are likely to be included in the scope of the purchase price allocation, be prepared to have documentation. And the remaining useful lives of these assets is a material consideration. If a trademark is going to have an indefinite life, then there needs to be a narrative that is convincing to the specialist and to the auditor as to why that's the case. Or if an acquired technology's remaining useful life is 3 years, why is that? You can benchmark against the remaining useful lives of similar assets and other acquisitions that are contained in public disclosures. You still can't allow the client to divorce themselves from this process. That rarely leads to a good outcome. So in terms of helping you thrive rather than survive the PPA, the first piece of advice I can give is to start the process right after the transaction. There's no reason to wait. And it's one less thing that you have to worry about when you're dealing with year-end close and all the other audit tasks that do require you to wait until the end of the year. It also helps that the client's mind is going to be fresh about where the documentation is. You might be able just to sort of log into the same data room that was used for the transaction. So it might save the client a little bit of time and heartburn. It's also a time where you can glean qualitative information from the client more reliably. If you consider all the things that go into a transaction and how transactions at the end tend to be fire drills, you're just going to get better client engagement if the client isn't also managing the sort of back office end of their audit at the same time. Get it done as soon as you possibly can. One of the questions is, who should perform the PPA? Well, I know who shouldn't perform it, and it's the auditor. And the reason is because if an auditor performs a purchase price allocation for their own company, they're put in a position of auditing their own work. And since the early to mid 2000s, that is called a conflict. There's nothing that explicitly prevents the client from performing their own purchase price allocation, but it's generally not a good idea. Putting the independence issues aside, a purchase price allocation is not something you just sort of watch a YouTube video and say, well, I'm going to have it come out all great. It's a little bit more complicated than that. You need to do about 15 to 20 of these before you really start to get comfortable. I think I can speak for auditors everywhere that their nightmare scenario is receiving a purchase price allocation from somebody who's basically doing it for the first time, right? Buckle up, and they know that it's going to be a rough ride. So it needs to be a third-party firm, but it can be another accounting firm. Some accounting firms are comfortable referring clients to other accounting firms. The Big Four do. Some accounting firms have no interest in potentially exposing a client to another accounting firm. When evaluating your specialist, the 3 E's apply. They need to have education, which includes one or more credentials. Expertise. There's some people that do business valuation part-time, and I think that's fine. But I don't think you can do it part-time and do purchase price allocations. I just think there's too much going on, too many technical issues. There are bulletins that are issued fairly frequently that offer new guidance on appropriate procedures, support, and so forth. It's just not a thing that's a good idea to dabble in, and experience matters. There's really no substitute for going through the process, getting beaten up a few times, which I certainly did early in my career. How do I know what not to do? Because I've done a lot of them. I happen to have the ASA. An underrated feature is whether the specialist has worked with the auditor before. The fact of the matter is that there is a comfort level when a specialist and an auditor work together. When an auditor recommends that you use a particular firm, consider that firm to do the work because there's probably a good reason for it. I won't even issue an engagement letter until I've spoken to the auditor. You can get out in front of so many things that could complicate this process with an email, with a couple of 10-minute phone calls. And for that amount of time, you're saving thousands of dollars of fees. Sometimes the client doesn't know everything about their own transaction. There are documents that exist that the client doesn't know, or your main contact doesn't know exist, but the auditor does. So there's just so much learning opportunity there. Encourage the client to be engaged. Many clients are going to be tempted to sort of throw this over the wall and say, okay, well, specialist, go take care of this for me and talk to the auditor and come back to me when you need me. Client engagement is important because the client ultimately owns the work product. They're responsible for providing the right information to the auditor, and they should understand what exactly it is that they're providing. The client will be in a position to make corrections, adjustments, suggestions, provide input before it ever hits the auditor's desk. And boy, if you can do that, that is going to make your life so much easier because the auditor is often not going to review this until the final stages of the audit. And that's where the fire drill happens because the questions then come back and you need them back within 24 hours of the same day to keep the audit on track. And if surprises in the PPA come up, those can be very difficult timelines to maintain. So I've provided a minimum list of documents. Before you even engage a specialist, they're going to want these documents. So if you're preparing a client for an audit, give them this list. Maybe you are the client themselves, or you're in a role where you're very embedded like a fractional CF. Take this list, set these documents aside, put them in a folder just called PPA documentation. If you're doing this right after the transaction takes place, the client knows exactly where these documents are. There's a lot to be said for doing this while it's top of mind. And here are more documents. Every assignment is different. Every specialist is different. So don't be surprised if they ask for slightly different things. Be advised that each intangible asset will have its own information request. Be prepared to capture non-documented information. There's institutional knowledge matters, and not everything that was considered inadequate, written down, stored on an email, put in a contract. It's conversations people had. It's what people were thinking. It's body language, people's doubts or things that they were really excited about. Maybe things that frankly they didn't want to document. The sooner that you start this process, the more likely it is that there will be mostly perfect recall of that information. Here's a sample list of mistakes to avoid, and I'm not going to disclose which ones I've done in my career, but it's not zero. Failing to have a full command of the rationale of the acquisition. You need to know why the acquisition took place. It's not good enough to simply to do a purchase price allocation based on simply an information request and not have an understanding of the flavor as to why it took place. Another common mistake, and this is a technical one, is failure to reconcile the rates of return that are used within the purchase price allocation. If they don't reconcile within 1% of one another, most auditors are going to kick that back. Math errors, failing to adequately document sources of assumptions. Footnote that say something more like, based on information that the client provided to the effect of XYZ, or gleaned from this particular document, cite that document. You see internal logic inconsistencies where the valuation models don't match the terms of the actual transaction. You see cases where the specialist decides to be adversarial and try to turn the client against the auditor to make, I guess, difficult questions go away. That's never helpful because the valuation specialist is going to be in closer contact with the client during this process than the auditor. When the specialist says, the auditor is just trying to make me jump through hoops, I don't know why they're doing this, the client's going to start to believe it. If you're advising a client or if you're a client yourself, don't allow that to happen. It's not constructive. The auditor The auditor isn't running a circus. They're not trying to make people jump through hoops. They're trying to meet their obligations as fiduciaries to make sure that all the aspects of the audit are addressed correctly. Another mistake is the client has got to understand the contents of the valuation report. And some people in my profession are bad about this. It's critical that the client understand what they're submitting to the audit. Ultimately, it is their work product. More mistakes to avoid. Correctly identify the assets and liabilities to be considered. Use valuation models that aren't something that you just sort of made up in your basement. And failing to account for minority interest. There are some acquisitions that do require a separate accounting for the minority interest, and it's not necessarily a trivial procedure from a valuation perspective. You don't want to submit this, have the client push back on the minority interest, and then you wind up redoing a whole bunch of the valuation because you didn't consider the minority interest. A lot of PPAs fail to account for deferred taxes as well as accrued net operating losses. They fail to define what a market participant is. What that means is, what is the profile of the typical buyer and seller? Is the buyer financial in nature like a Warren Buffett, or are they buying with a strategic goal in mind, such as a Microsoft or an Apple? Or is it a hybrid? Is it a private equity fund that's doing roll-ups? That market participant profile does need to be clearly identified. Otherwise, you don't have the proper context or lens through which you view the entirety of the valuation. And finally, assuming that the target company is an exemplar of the industry overall. Sometimes that's true, but sometimes it's not. Let's say if a company is financially underperforming, then it may lead to the valuation of identifiable intangible assets being undervalued and therefore leading to excessive goodwill. One of the more qualitative elements of the analysis, it's a critically important one to make sure that the PPA is ultimately reliable and credible. A good PPA has lots of footnotes. A good purchase price allocation report should contain the same information as a 30-page narrative report. And you can accomplish that by just taking the time to put in footnotes. If you don't see a lot of footnotes, or the ones that you see appear to be very vague, ask your specialist to go back and add the footnotes. For every one of these assumptions, footnote them. And the specialist may push back and say, well, that's going to take a lot of extra time. Is that really necessary? I'd probably answer them something kind of cheeky. I'd say, well, how much time is it worth to get this thing done correctly? And they'll usually go back and do it. And I don't think they should charge you more for that, because I think that's the way that should be done in the first place. The person I took financial statement analysis from in graduate school, he taught us to read a financial report starting with the footnotes. And I think the same can and ought to be true for a purchase price allocation. I hope you found things that you can take away and apply the next time that you are involved in a purchase price allocation. I'd like to thank all of you for listening to this content. I hope you can apply the contents to acquire a good purchase price allocation report.